Happy New Year. Hello and welcome to the Nutmeg Investor Update for January 2021. I'm Liebetrau, Financial Advisor here at Nutmeg. With the government guidance for people to stay at home and new lockdown restrictions in the UK, the Nutmeg team continue to work remotely and will be filming our updates via Zoom once again. I'm joined today on Zoom by Brad Holland, our Director of Investment Strategy. Hi, Brad.
Hi, Chris.
Brad, we'd usually start with a look back at the previous month's markets, but there's been a lot of activity at the start of January. So let's kick off with the news from America that the Democrats won the 2 runoff election seats for the Senate in Georgia, bringing the Senate to a 50-50 split and Harris having a deciding vote. How have markets reacted and what does this mean for Nutmeg's US equity exposure?
Well, the first thing it means is that Biden will no longer face obstructionist Senate, at least not until the midterm elections in 2022. So we can expect more fiscal intervention and an upward pressure on US bond yields. But we should remember too that President Biden is a centrist politician, so we don't expect an explosion in US debt. Now, in these uncertain times with COVID, geopolitical tensions, and the rest, it's actually very helpful to have a unified Congress. But the Republican senators can still use the filibuster to obstruct Democrat legislation. To avoid that, the Democrats need 60 seats, not the 50 they have in the split Senate. But President Biden will certainly bring nuanced changes to the way tech companies are regulated or regulate themselves, changes to US international policy, and potentially also an unwinding of some of the Trump administration company tax reductions. But again, Biden is a centrist and a very experienced politician. He knows that his political fortunes, as well as those of the US economy, depend on company investment and employment decisions over the next few years. So his administration is unlikely to go too hard on corporate America. On balance, in the short term, we think a Biden administration will be good for equities, but not so great for bonds, given the likely increased government stimulus. And this is the way Nutmeg fully managed portfolios are already positioned, though we're always ready to alter that mix as the impact becomes clearer.
Thanks, Brad. So coming back to the UK, there's been a lot of news here too. We finally had confirmation of the UK's trading arrangement with the EU following Brexit. The start of the rollout of 2 vaccines encountered a new strain of COVID, and we've gone into another major national lockdown. What does this all mean for markets?
Well, on Brexit, it means the UK does remain open for business, avoiding a shock to the trading terms with the EU. As the December deadline loomed, and despite both sides publicly flirting with no deal, it seems European and British commercial interests overruled the remaining political obstacles. Clearly, there are wrinkles still to be ironed out in services, a very large part of the UK economy, and these will be addressed at the industry level. So the shock from Brexit will be real, just lower than it might have otherwise been, which leaves the third national COVID shutdown and a new strain of virus as the key short-term risks. As they return to work and review their investment strategies, market participants will need to absorb all of this. On currency, the weak dollar is the key story right now, but the chances of a recovery of sterling versus the euro have risen following the Brexit deal. On bonds, again, the US bond market is the key short-term influence. I mentioned the negative impact of a Biden presidency and continued global recovery, but there is also potentially some Brexit premium still to be taken out of UK government bonds. On equities, the very underweight international investor position in the UK may be the main short-term driver, along with stronger commodity prices. These are pushing up UK large cap prices at the moment, but we also expect mid-cap size companies to do well if sterling appreciates and if the UK economy can withstand the third shutdown. Alongside all this is the consideration about the efficiency of vaccines against the new variant virus. The early signs are optimistic, but the ability of the UK economy to recover into 2021 does depend on this, as do UK asset prices.
Okay, so that's an update on recent events. We should get back to the month of December and look at how the year ended up. Can you give a sense of what happened and why?
Well, stock markets had a good December with emerging markets and small cap companies performing the best. To a large extent, what was happening here was a catch up with developed market large cap gains throughout 2020. By a very long stretch, large cap US technology companies, the NASDAQ index, had the best year last year, posting just under 50% rise, fueled by a surge in online demand and home working due to COVID shutdowns, as well as large falls in US interest rates and bond yields throughout the year. Elsewhere, commodity prices had a good December, with gold and oil prices both up strongly, which both led to a weaker US dollar. A greater political clarity and stability, as I've mentioned, seemed possible in December under Biden. We saw Trump's legal challenges fail. We saw continued policy support for the economy. A re-pivot towards Asia is expected, and a return to US internationalism after Trump's America First phase. As a result, we expect greater international cooperation and more pragmatic China policy. Of course, the vaccine rollout gathered pace in December too. And also better economic and trade data kept rolling in during December, a good sign of economic healing. Inflation was also shown to be very much alive. There were wages growth, commodity prices rose, inflation expectations also rose. And this theme of ongoing recovery saw a shift in support from growth stocks to value stocks like small cap and emerging markets, especially Latin American emerging markets. Consequently, US and European government bonds had a slightly weak December, but UK government bonds were stronger on that increased chance during the month that Brexit may have occurred without a deal.
Okay, great. So given all of that, were any changes made to Nutmeg's fully managed portfolios in December?
At the start of the month, we trimmed some of our US overweight back into the UK, although UK exposure remained heavily underweight. Higher risk portfolios were also allocated more emerging market equities. Now, when the balance of likelihoods around Brexit took a turn for the worse during December, we moved some cash into government bonds as additional protection against a no-deal Brexit. We remained underweight bonds, however, and therefore underexposed to the risk of higher interest rates.
Okay, and could you surmise how fully managed portfolios have performed in December and how they came out of 2020?
Higher risk portfolios rose 3.5%, mid-risk 2.5% to 3%, and lower risk portfolios rose between 1% and 1.5%. Now, over the year, despite the pretty spectacular gyrations in March, higher risk portfolios ended up around 7% on the year, mid-risk around 6%, and portfolios 2 and 3, the lower risk, were up 3% and 4% respectively. So investors that stuck to their investment plans throughout the volatility were rewarded last year.
Thanks, Brad. Okay, so this month's investor question comes from Chris Carr, who asks, with the current cryptocurrency run, would you consider investing small positions in Bitcoin or Ethereum?
Well, Chris, you are right to point out the blistering rise in these prices since late last year. We've noticed them too, so much so that we wrote an article on crypto coins over the holiday period, and you can find that on our website. Now, the short answer is that we don't see these instruments as a bona fide investment just yet. Now, of course, blockchain and distributed ledger technology is a very real and game-changing future prospect, but understanding its future form or how entrenched the technology will become across all sectors of the economy is difficult. And very importantly, we don't know what transaction technology will accompany this. And you mentioned Bitcoin and Ethereum, but it is by no means clear either of these will be part of the future system. For now, this space really is being overrun by speculation and the rush of trading platforms to service this speculation. Fear of missing out is a key driver of the speculation, but is no basis for a long-term investment strategy, which are all about liquidity, transparency, and diversification. Unfortunately, crypto comes up short on all these factors, and that's echoed this week by the FCA with its warning that coin investors need to be prepared to lose everything.
Thanks, Brad.
Thanks, Chris.
And thank you for joining us. If you have a question for Brad or the investment team, you can contact us via social media or in the comments section below. We look forward to seeing you again next month.